Ladies and gentlemen, welcome to the third quarter 2013 Cadence Capital Limited webcast, and a particular welcome to all of our new shareholders. And there have been a significant number of new shareholders in our recent placements. We have around 1,200 new shareholders. The most recent shares that went out under our prospectus were issued on the 11th of April, and people should have received them on around the 12th of April. I think one of the important points that we want to remind existing and new shareholders of is that all shareholders are now entitled to the 6 cents fully franked dividend that was that our stock went ex on the 18th of April, a few days ago, and that dividend will be paid on the 30th of April. The 6 cent fully franked dividend will be added to the dividend table that you see on the slide in front of you, and will form over time the accumulated dividends that we've paid out, as well as the accumulated frankings that we've paid out since being listed as a listed investment company in 2005. Turning now to the next slide, which most of you will recognize as the performance slide, one of the performance slides that we put out in our monthly newsletter. You will see that for the March quarter and for the year to date, we are up around 15%. The market was actually at one stage up almost 20%, and our numbers were up around 17, 18, 19% as well. But the market has come off a little bit in the last few weeks, particularly in the last 2 weeks, and the All Ordinaries Accumulation Index is once again below 5,000, and the resources stocks in particular have been very heavily hurt. In actual fact, I was looking at some slides the other day showing the banking stocks, some of the diversified financial services stocks in the last 6 months as having gone up around 30–35%, and over that same period resource stocks are off around 30 or 35%. So almost a 70% differential between owning banking and yielding stocks as opposed to owning resources stocks. I mean, that's a very, very big difference in such a short space of time. Turning a little bit now away from the short term to the longer term, which in the end are the important numbers for the fund, that medium and long-term investment profile. The fund has returned around 20% per annum gross over an 8-year period, and the All Ordinaries Accumulation Index has returned around 4.5–5% for that period, depending on which numbers you're looking at. So that our fund has had 14 to 15% alpha generation or outperformance over an extended period of time. And that is the number that we hope to maintain and preserve, and is the reason why we have such a high percentage of our own wealth invested in this listed vehicle. The slide below the performance number shows the exposure of the fund over time, and I think it's important to understand for many of our shareholders that we have the potential to hold very high levels of cash or to be 100% invested. So as an investment team, we not only look to invest in stocks, but we also are at times holding high levels of cash and making decisions about when to enter stocks and when to exit stocks. And that leads us at the moment to a position where we're holding nearly 50% cash in the current investment environment. And we have had a number of questions on that cash holding, and a number of questions by new and existing shareholders on what we intend to do in this environment holding high levels of cash, and are we intending to invest in a particular sector or a particular space? What are we doing with that cash? I think and this is what has prompted really the content of this webcast, which is where we intend, the short answer, we intend to continue to invest money the way we've been investing for the last 7 to 8 years. And the philosophy and investment style of the fund is really outlined in the next 4 slides. These 4 slides are essentially unchanged in our presentations over the last 7 to 8 years, and we think it's a timely reminder and also a good introduction for new shareholders to see the investment process and the investment style. The investment philosophy and belief for Cadence Capital and Cadence Asset Management, the management team, can be summed up really in one line, and that's outlined in the slide here, and that is that we believe the use of both fundamental and technical information has a greater probability of outperforming either fundamental or technical analysis alone. Whenever I have these kind of academic or philosophical debates with fellow fund managers, the issue often turns to whether fundamental analysis is better than technical analysis, or whether technical analysis is better than fundamental analysis. For us, that isn't the issue. The issue is using both of the tools at our disposal, we feel, is far better than using either one or the other. We would use many of the tools that we thought were at our disposal to try and outperform the market, because in the end that's what we're trying to do. The fundamental side of what we're doing is really an adaptation of William O'Neill's CAN-SLIM analysis, and involves looking at the PEG ratio for a stock, which is the PE of that stock divided by the EPS growth for that stock for this year and the next 2 years, the operating cash flow yield for the stock, the free cash flow yield for the stock, the level of debt and the level of cash for that stock, and also the industry strength and that particular stock's position within the industry and its relative bargaining position. That's our starting point for fundamental analysis. We then use technical analysis to overlay when to enter and exit positions, and that becomes the disciplined and detailed process of how to add to positions and how to reduce positions in our portfolio. We follow these detailed entry and exit strategies, and we refer to this as our technical analysis, and it assists us in entering and exiting positions. The following slide, titled Fundamental Research, is really the crux of what we're doing on a daily basis. In the top part of the slide, you can see that there are 2,500 stocks listed in Australia. Those 2,500 stocks incidentally represent about 2.5% of the world's market capitalization. Of those 2,500 stocks, 700 made a profit last year, and we believe that it's the 700 stocks that made a profit and a cash flow that you're even in a position to fundamentally analyze. Of those 700 stocks, we think about 90% of them are what we call average. They have average returns on equity, average operating cash flow yield, average free cash flow yield, average levels of debt, average level of cash, a diversified income stream, and are really not the area where we're focusing our attention. We're looking for those 5% of stocks in any given year that are cheap, and those 5% of stocks in any given year that are expensive and sit on the end of the bell curve. Those stocks display characteristics on what we call our stock profile. On a long position, they may be growing at 20% per annum, on a PE of 10, operating cash flow of 8 to 12%, free cash flow of 5 to 8%, net cash on the balance sheet and no debt. If we find a stock like that, well, we're very interested. That's a potential long position. Conversely, if we find stocks making a profit but trading on multiples of 20 times PE, only growing at 8% per annum, with 3 to 5% operating cash flow yield, little to no free cash flow, lots of debt on their balance sheet and no cash, well, we're alert to those stocks as being expensive and potentially good shorts and businesses that can run into trouble. We saw during the GFC that property trusts, financial engineering companies, highly geared balance sheets, stocks such as ABC Learning, MFS, Babcock & Brown, these were all companies that in the end didn't meet our long criteria and were really in the end quite good shorts. So this starting point, us visiting 300 to 400 companies a year, which involves our analysts visiting about 1, sometimes 2 companies a day, is the starting point for fundamentally analyzing a company. And we track these company visits and the fundamentals around the stocks that we visit on a daily basis. And so the object here is to try and identify stocks that are cheap and stocks that are expensive. And ideally, we want to be buying cheap stocks and shorting expensive stocks. Up until now, most people would be reasonably comfortable with that as a concept, and we would have all, in one way or another, heard, learnt or read about the concept of buying low and selling high. Now, presuming that everyone is doing this, the question then is, why are some people doing better than others, or why are some funds performing better than others? And from our point of view, that is because, yes, this is the starting point for doing fundamental analysis. And I might add, many funds are not allowed to invest this way. We invest with what's called an open mandate. If a stock were to appear in a top 100 companies profile, but it wasn't a top 100 stock, they wouldn't be able to buy it, for example. Many funds are not allowed to short stocks. Many funds are actually not allowed to hold cash if they're uncertain about what the environment ahead holds. So our open mandate, we believe, is immediately an advantage compared to a defined mandate. The second component to our investment process is now what we call the technical investment process, and that starts on the following slide. Looking now to the technical research slide, if we find something that's fundamentally cheap, but the share price is falling, we don't touch it. Using an example today, many of our fundamental brokers are ringing us, research brokers are ringing us and saying that resource stocks are really, really cheap, fundamentally cheap, and they continue to fall in value every day. So for us, the point is not whether they're cheap or expensive at the moment, but the fact that they're just constantly falling, and that these earnings might have to be revised, and they actually might not look that cheap. So the point here is on the left hand of the slide, we do not buy falling stocks. Similarly, we don't short stocks that are going up. If someone says to us, I used an example from 6 months ago, a company called Xero looked expensive because it has $1 billion market cap, it has no earnings, and it has negative cash flow. It may have looked expensive at $1 billion, but the shares are rising in value, and since then have risen from $7 to $10. Potentially they're more expensive than they were. The issue would have been if you'd shorted them at $7, you would have lost $3 per share. So this is the first filter for our fundamental analysis of a technical nature, which says you either can or cannot invest in a stock. The next slide is really the one that's important. If we find something that's fundamentally cheap, the share price has fallen from, say, $4 to 12 cents in the case of a Reckon after the internet bubble and burst, and we analyze that stock and see it as fundamentally cheap, and the stock's price starts to recover, we might add 1% at 15 cents, 1% at 18 cents of our portfolio, 1% at 21 cents, 1% at 24 cents, and eventually accumulate a 5% position adding into that stock. And then we would at most own 5% at cost in our portfolio in a particular stock. And if we've got the fundamental research right and we've entered the stock at the right time, that stock can then potentially double, triple, quadruple, or as Peter Lynch would say in his books, you're looking for the 10 bagger, the stock that goes up 10 times. In that example with Reckon is up 20-fold since the tech wreck that occurred in 2001. On the converse, when we go to sell these positions, if a stock goes from 20 cents to $2 and then becomes in the end overvalued and might retrace then to $1.80, $1.60, $1.40, we would then scale out of that position maybe a third at $1.80, a third at $1.60, and a third at $1.40. So on top of visiting companies every day and working out whether they're cheap or expensive, we are on a daily basis working out whether we should be scaling or adding to an existing position, or scaling out of or reducing exposure from an existing position. And those two processes combined are the process of using technical and fundamental analysis to dictate the exposure of the equity exposure within our fund. The final technical slide refers to shorting, which is really just the mirror image of going long a stock from a technical point of view, and that is when a stock rolls over after having been expensive, we short 1%, then a 2%, a 3%, a 4%, and a maximum 5%, and when the stock turns around and starts to go back up, we buy it back 1/3, 1/3, and 1/3 as it recovers, so that allows us to scale into and out of shorts. Important things with a short, of course, is a short you can lose an unlimited amount of money if you short a stock at $1. You don't know how high the stock could potentially go. And the other thing about that is the most that you can make on a stock that you short at $1 is $1, because then the stock will be zero. Of course, when you go long a stock at $1, it could end up going to $10. And this is why we, in the end, run a long-biased long-short fund, because we understand that a stock bought at $1 can go to $10, and a stock shorted at $1 can only go to $1. So in the end, our process, we could start off with as many longs as we had shorts, but in the end, our process would cause us to be net long-biased. And that has in actual fact been our experience over the last 7 to 8 years. That really is a summary on 4 slides of what we call our core positions and how we accumulate fundamental positions within our fund. And that is about 80 to 90% of the daily work of the investment team here at Cadence Capital Limited. Turning now to market participation, or the remaining 10 to 20% of time that we spend on a daily or weekly basis. This part of our portfolio refers to participating in IPOs, placements, share purchase plans, rights issues, underwriting, block trades, dual arbitrage, listed arbitrage, convertible note arbitrage, This trading part of our portfolio, we say with trading, in good times it can deliver about 20% of our returns or alpha, and in bad times delivers nothing. The discipline in this trading or market participation side of our portfolio is when times are bad to stop doing it completely, and when times are good to participate, but to recognize that these trading parts of your profit, the profit from trading, is very, very cyclical by nature. And so the trick here is to be very disciplined about how to get in and out of these positions. Of course, the secondary effect of being involved in all of this market participation and seeing what we call the flows of equities within the market and going through equity capital markets divisions and brokerage firms is that we get to see a lot of what's occurring within the equity space in Australia. And that is that in itself is a very, very valuable tool for us. I hope that these 5 slides, which are really a very short and summarized version of how we invest our money and your money in the fund, give a little bit of insight into how we have invested money over time. Ladies and gentlemen, I'd like to once again thank you for watching this webcast, and also for your continued support as shareholders within the Cadence Capital Limited Fund. And I'd also encourage everyone watching this webcast, or everyone who's become a shareholder recently, to go onto our website and join the monthly newsletter distribution list, so that you do receive regular updates on a monthly basis on how the fund is performing. And also we, on a monthly basis, write short notes of interest or things that we're seeing that may have occurred in the marketplace. And then of course that distribution list also gets the quarterly webcasts, which you're now viewing, so that you will receive on a quarterly basis a webcast, and on a monthly basis the newsletter. Thank you very much for your time, and should you want to get in contact with us, please email us or contact us on the work telephone number. Thank you.